Is anyone else wondering if we're on the verge of seeing a dollar collapse? The dollar has been declining against its original value in gold since the 70s, and trillions of dollars were added into the economy just recently, which caused the highest inflation in 40 years. The Fed had to raise interest rates to get this inflation down, but we're seeing the negative impacts now in the economy. From 2023 to the beginning of this year, there have been 5 major bank failures, totaling over $500 billion in losses. This is already more than the losses that happened during the Great Financial Crisis in 2008, where 500 banks failed, and it totaled about $73 billion. This year, NYCB, one of the largest regional banks in the US, is struggling because instead of keeping depositors' money in the bank, because banks don't really do that anymore, they had a lot of their holdings invested into the dying commercial property sector, and they bought out SVB, which failed last year. This is a story of how the US Ponzi scheme is failing. Now, let's take a step back in time. Here's a little history lesson about money. Money used to be tied to tangible assets, such as gold. This was called the gold standard. This meant that the price of gold in the market would directly determine the value of the currency. It also gave people confidence that their money had real worth. The US dollar became the new world reserve currency in 1944 when other countries decided to hand over their gold reserves to the US in exchange for US dollars. This was known as the Bretton Woods Agreement. Having a world reserve currency makes it easier for countries to transact with each other because you don't have to figure out exchange rates and all that extra stuff. It's important to note that the previous world reserve currency, the pound sterling, failed because they depleted their gold reserves, paying for wars. The US government also started funding wars after Bretton Woods, and for that reason, the belief in the dollar's stability started to fade. Because there was only a limited amount of gold, there had to be a limited amount of dollars for the dollar to remain stable. It made it hard for the economy to grow, and the government could not inflate the dollar at their will. But they were determined to maintain their global dominance and keep expanding. So, in 1971, the US government made the decision to stop the direct exchange of the US dollar and gold. Now they could inflate the money supply as they pleased because it was no longer directly tied to the amount of gold they had in their reserves. They still arbitrarily based the value of the dollar on that amount in gold, but they didn't need to get more gold to print more dollars. You might be wondering, how does the dollar get its value? Well, the value of the US dollar is by something more abstract, trust and faith in the US government or the government's ability to manage the economy. This is what we call fiat currency, and it means that the US dollar has value because the US government says so. I know it sounds ridiculous, but stay with me. I'm sure you have heard the phrase, money doesn't come out of thin air. Well, that's pretty much where the US dollar comes from. Commonly referred to as the Fed, the Federal Reserve System of the United States is tasked with managing the supply of the US dollar. The Fed acts as the United States' central bank, can create policies that make dollars or take them out of circulation. The Treasury Department then creates the dollars that are to stimulate the economy by electronically adding or subtracting numbers. Now, because of something called supply and demand, when there is more supply of dollars, the value of each dollar goes down, causing prices of other things like food to increase. When there is less supply, the value of each dollar goes up and prices of other goods stabilize. The US dollar is printed by the United States Department of Treasury. But how does the US dollar circulate in the economy? The Federal Reserve System controls the supply through various means. One way the Fed works is through something called open market operations. Here's how it works. When the central bank wants to increase the amount of money in the economy, it buys government securities like bonds or packaged debt that have a guaranteed value from banks and investors. This gives those banks and investors more money to lend out, which can stimulate borrowing and spending, causing the economy to boom. Then, if the central bank wants to decrease the amount of money in the economy, it sells government securities to banks and investors. This takes money out of circulation, making it harder for people and businesses to borrow and spend. Typically, the Fed will do this if inflation is very high and the dollar is losing value, just like in present day. Let's imagine you're at a party with your friends, and there's a big bowl of candy that everyone can grab from. When the party is just getting started and people are a bit slow to mingle, you might decide to pour more candy into the bowl to encourage everyone to grab some and have a good time. This is like the central bank buying government bonds to inject more money into the economy. As more candy gets added to the bowl, people start grabbing handfuls, chatting, and having fun. This mirrors how, with more money available, people and businesses start borrowing and spending more, which stimulates economic activity. But let's say things start getting a bit out of control. People are grabbing so much candy that the bowl is emptying out fast, and there's a risk of running out before the party is over. To prevent chaos and keep things under control, you decide to slow down and refill the bowl at a slower pace. This is like the central bank selling government bonds to take some money out of circulation, slowing down borrowing and spending to prevent the economy from overheating. So just like adjusting the candy supply at a party to keep the fun going without things getting too wild, the central bank adjusts the money supply in the economy to keep things running smoothly without inflation or economic downturns getting out of hand. Other banks also play a huge role in money creation. Like a never-ending cycle, when you deposit money into a bank, they don't just keep it locked away in your account, they borrow to those who need it for things like mortgage or car loans. When whoever loans it spends it, it ends up going back into the bank just like a loop where then they loan it out to someone new. Now, you might be thinking, if money is just being created out of thin air, isn't that a bit sketchy? Well, that's exactly what I mean when I refer to the US dollar as a Ponzi scheme. It's really a debt-backed system. Yes, bank operations are bound by legal regulations and frameworks, but just like a Ponzi scheme where early investors are paid returns from the investments of later participants rather than from legitimate profits, banks rely on continuous deposits and loans to sustain their operations. This is a rather unsustainable structure because just like Ponzi schemes, with a significant withdrawal or default, the whole thing could come crashing down. So it's safe to say that the US money creation is tied to a debt cycle, which obviously is bad news. In fact, for a while, banks were only required to keep 10% of their holdings, people's deposits, in liquid cash. They no longer have to keep any cash deposits. On the surface, debt looks like a boost to the value of living. Governments leverage debt to fund infrastructure projects, social programs, and military expenditures, while businesses utilize credit to expand operations and drive shareholder returns. Likewise, consumers rely on debt to finance education, home ownership, and car loans. Yet behind these positives is a cloud of fundamental imbalance ready to storm. So, just like how maxing out your credit card can lead to trouble, if the government borrows too much, it can be hard to pay it all back. Have you stopped to think about what happens when there is a recession, when there is inflation and the cost of living is at an all-time high? When prices go up and money doesn't go so far? Picture this. When the economy is doing well, people and businesses borrow money to invest and move the economy. But when things slow down, people stop spending, causing a downward spiral. We saw this play out in the global financial crisis between 2007 and 2008. Unsustainable debt levels resulted in a huge economic meltdown. It made a lot of banks fail. People lost their homes, some lost their jobs. In an effort to inject money into the system, the central bank slashed the interest rates to near zero levels and flooded the financial system with liquidity, which is what we came to know as quantitative easing. So they went on a spending spree, buying government bonds and other securities like mortgage-backed securities from commercial banks and other financial institutions. But though these actions stopped the economy from totally falling apart, they also sowed the seeds for future instability. When there is more money available, people take on riskier investments. The COVID-19 pandemic also unleashed another round of pandemic turmoil. In the United States, the Federal Reserve embarked on yet another round of quantitative easing, pledging to purchase an unlimited amount of government securities to stabilize financial markets and support lending. Also, Congress approved lots of money to help the economy, like giving cash directly to families, that couple $100 stimulus check, increasing unemployment benefits, and giving loans to small businesses that they personally don't have to pay back if they meet certain conditions. But what they didn't tell you, still pay for it one way or another, like higher taxes or higher prices of goods. Because the Fed inflated the money supply to levels never seen before, the dollar was devalued, and that's why you are paying almost double for the exact same things you were buying a year or two ago. Because inflation was sky high, the government started doing quantitative tightening to take supply away from the market by selling bonds and raising interest rates. Higher interest rates is harder for borrowing and lending, which puts strain on the economy. Yet it is the only way to fight high inflation with the way our economy is structured. Now, how long can this never-ending loop sustain the U.S. currency? There's an underlying worry that this method of money creation will eventually catch up, though some may argue that as long as the government can keep inflation in check, there's no reason to worry. Plus, with the rise of digital currencies like Bitcoin, there's potential for new ways to manage money that could shake up the system. Yes, all of these are true, but the concern remains a valid one. The US dollar right now is like a ticking time bomb. If people understand monetary policies better, they can advocate for ones that benefit them. Without this knowledge, vulnerable communities are left vulnerable to economic ups and downs. If people start to doubt the government's trustworthiness, it could lead to the dollar losing value and causing a meltdown. While using fiat currency gives us flexibility, it also comes with risks that need to be managed carefully. Diversifying and holding value in different hard assets like gold, properties, businesses can help hedge or protect the individual's net worth. What then is the role of the central banks in all of this? Greater transparency and accountability are essential to restoring trust in the monetary system. These policymakers are public servants that are paid by the people's tax dollars, yet the few make life-altering decisions for the many. Inflation makes those who own assets outside of dollars richer and those who only hold dollars poorer. And who knows, it might be time to turn on the printer again and make some bills.